Ever feel like you want to be a smarter investor, but just get lost in all the financial jargon? Like it's designed to be confusing.
Oh, absolutely. It can feel overwhelming.
Yeah. But what if there was, like, a classic guide, a map to figuring out the market without needing a finance degree? That kind of leads us to Benjamin Graham and his book, The Intelligent Investor.
He's such a foundational figure. I mean, really, you could put him up there with the giants in other fields, like Isaac Newton in physics. Graham's influence on investing is huge.
The father of value investing, they call him.
Exactly. And this book, The Intelligent Investor, first came out in 1949. It's basically considered the Bible of value investing.
Wow, 1949. That's quite a while ago, especially in market years. So look, our aim today isn't to get bogged down in every single chapter detail or, try applying advice that might be a bit dated.
Right.
Instead, we're doing our usual deep dive. We want to pull out the core ideas, the really timeless nuggets of wisdom from Graham, give you a shortcut, maybe, to understanding his main principles and how they might, just might, still help navigate today's pretty crazy market.
That's the plan. And we've looked at a bunch of stuff to get us there. We've got summaries from places like Investopedia, book reviews from FinIdeas, Charles J. Lee.
Practical takes, too, right? From Picture Perfect Portfolios and NetNet Hunter.
Yep. And even checked out a Reddit discussion to see what folks are saying about it now. Plus, perspectives from the University of New York and Prague, Motley Fool UK, some critical takes on specific chapters, TrustNet summary points, and Sam Hollander's breakdown of investing versus speculating. It's a good mix.
Okay, so the big questions for this deep dive are, what are Graham's key ideas in The Intelligent Investor? Value investing, margin of safety, how to think about the market. And then how do these ideas actually hold up today? We'll definitely touch on some of the modern critiques as well.
Sounds good.
All right, let's start with the absolute core, value investing. What's the essence of it?
At its heart, value investing is pretty straightforward. It's about figuring out a stock's intrinsic value, what it's fundamentally worth, based on the business itself, separate from its day-to-day market price.
So you're digging into the company, assets, earnings, dividends, that kind of thing.
Exactly. You're looking past the market noise, the hype, to the actual substance of the business.
And the goal then is to find stocks where the market price is less than that intrinsic value, like finding a bargain.
Precisely. Those are the undervalued opportunities. You buy them when they're cheap relative to their real worth, and then you hold them patiently until the market price hopefully catches up to that value. It's often called mean reversion.
Graham even gave us formulas for this, didn't he, to estimate intrinsic value?
He did, yeah. Though they've evolved a bit. The original was something like value equals earnings per share times 8.5 plus 2 times the growth rate. Where 8.5 was kind of his baseline PE for a company not expected to grow, and G was the growth rate. Later, he revised it, adding factors for interest rates, like the risk-free rate and corporate bond yields, to make it more dynamic. So V, EPS 8.5 plus 2G, a 4.4Y.
Right. Those look a little formulaic, maybe a bit intimidating if you're not a math whiz.
Well, and that's a key point from our sources. These are tools for estimation. They're not crystal balls giving you the exact right number.
It's more about the process of thinking about value separate from price.
Exactly. Graham himself really pushed investors to focus on the real-world stuff, how the company's actually doing, the dividends it pays out. Not just getting swept up in the market's daily mood swings, what he famously called market noise.
That's a great transition to another huge concept of his, the margin of safety. Sounds defensive.
It is. It's absolutely crucial. Margin of safety means buying a security only when its market price is significantly below your estimate of its intrinsic value.
So building in a cushion.
Precisely. It's a buffer against errors in your own valuation. Because let's face it, nobody gets it perfectly right every time, and it protects you against unexpected bad news or market downturns.
I love Warren Buffett's analogy for this. He's Graham's most famous student, obviously.
The bridge analogy.
Yeah. Build a bridge that can hold 30,000 pounds, but only drive 10,000-pound trucks across it.
It perfectly captures the idea. You want that extra capacity, that safety room. Guideline-wise, maybe aim to pay 90 cents for a dollar of value for a really solid company. For something riskier, you'd want an even bigger discount.
So the core principle is just don't overpay, no matter how great the story sounds.
You got it. And the better you get at analyzing the business itself, you're reading those financial statements, understanding its earnings power, the better you'll become at spotting when the price is significantly different from the value.
And you definitely need that buffer because, as Graham pointed out, the market isn't always rational. Which brings us to Mr. Market.
Ah, yes, Mr. Market. Such a brilliant, simple way to think about the stock market's personality.
Explain him for us. He's like a business partner, right? But a really moody one.
Exactly. Imagine you own a piece of a business and you have this partner, Mr. Market. Every single day, he comes to you and offers to either buy your share or sell you his share.
Okay.
But here's the catch. Mr. Market is emotionally unstable. Some days he's incredibly optimistic, euphoric even, and offers you a ridiculously high price for your share. Other days he's deeply depressed, panicked, and offers to sell you his share for way less than it's worth.
So he swings between extremes.
Wildly. And Graham's point is, the intelligent investor doesn't get swayed by Mr. Market's moods. You don't feel obligated to trade with him just because he shows up.
Instead, you use his moods to your advantage.
Precisely. You happily sell to him when he's offering you a crazy high price, and you gladly buy from him when he's offering you a bargain basement price. You treat his offers as opportunities, not as information about the real value of your business.
So ignore the noise, focus on the value, and use the market's irrationality. Don't participate in it.
That's the essence of it. His daily prices are just offers on the table, not a verdict on your investment's worth.
And that ties into another key Graham idea. Viewing yourself not just as a stock trader, but as a part owner of the actual business.
Absolutely fundamental. When you buy a stock, you're buying a piece of a company, a real entity with assets, operations, management.
It's not just a ticker symbol flickering on a screen.
Right. So you need to understand the underlying business value. What makes it tick? What are its prospects? You can't figure that out just by watching the share price bounce around.
And Graham felt shareholders should ideally act like owners too, though maybe he got a bit cynical about how much influence small investors really have.
Yeah, he seemed less optimistic about shareholder activism later on, but the core principle holds. Think like you own the place, because in a small way, you do care about the business itself.
Okay, now Graham also talked about different types of investors, didn't he? Defensive versus enterprising.
He did. He recognized that not everyone has the same amount of time, interest, or risk tolerance for investing, so he outlined two main approaches.
Let's start with the defensive investor. What's their profile?
The defensive investor's main goal is safety, avoiding big mistakes, and achieving sort of adequate returns without a huge amount of effort.
So more passive?
Generally, yes. They'd focus on diversification, maybe through index funds or a broad portfolio of established dividend-paying blue-chip stocks. They'd also typically maintain a balance between stocks and bonds. The analysis is simple, focused on quality, size, and consistency.
That sounds like a good fit for someone who, wants their money to grow but doesn't want investing to be a second job.
Exactly. Now, the enterprising investor is different.
How so? More hands-on.
Much more. The enterprising investor is willing to put in the time and effort to do more thorough research, potentially take on more risk, all in the hope of achieving better than average returns.
So they're actively trying to beat the market.
That's often the goal, yes. This involves active stock selection, maybe looking for undervalued situations, using Graham's value principles, exploring special situations, maybe even growth stocks if the price is right. It requires significant research and skill.
So defensive is about safety and steady growth with less effort. Enterprising is about actively seeking higher returns through more work and potentially more risk.
You've got it. Two different paths based on your goals and willingness to engage.
But for both types, spreading your money around diversification and asset allocation, that's still key, isn't it?
Oh, absolutely critical. Diversification isn't just about owning lots of stocks. It's about spreading investments across different asset classes.
Yeah.
Stocks, bonds, maybe real estate, commodities.
And then within stocks, diversifying further, like different industries, different countries.
Exactly. Different sectors, different geographies, mixing defensive stocks with more cyclical ones. The whole point is to minimize risk.
Because if one area gets hit hard, hopefully something else in your portfolio holds up or even does well.
Right. Think about the 2008 crisis. Diversification helped cushion the blow for many investors who weren't overly concentrated in financials or real estate. It smooths out the ride.
And it's not a one-time thing, is it? You need to rebalance.
Yes, Graham stressed that too. Over time, some investments will grow faster than others, throwing your original allocation out of whack. So you need to periodically adjust, sell some winners, buy more laggards to get back to your target mix.
Okay, makes sense. Now, whether you're defensive or enterprising, you mentioned earlier that understanding the company's health is vital. That means looking at financial statements can sound daunting.
It could seem that way, but Graham focused on the essentials. You need to look at the income statement that shows revenue, expenses, and ultimately the profit, or net income, and earnings per share, EPS.
Profitability, basically.
Right. Then the balance sheet. That's a snapshot in time showing assets, what the company owns, liabilities, what it owes, and the difference, shareholder equity, which is the owner's stake.
Financial stability check.
Yep. And finally, the cash flow statement. This tracks the actual cash coming in and going out from operating the business, from investing activities, and from financing activities. Cash is king, after all.
So analyzing these three income statement, balance sheet, cash flow gives you a real picture.
It gives you a much clearer view of profitability, stability, and cash generation. Absolutely essential for finding those potentially undervalued companies Graham talked about.
And doing that kind of analysis, that homework, is what separates investing from just speculating, right? Graham drew a sharp line there.
A very sharp line. This distinction was incredibly important to him.
So in his view, what is the difference?
Investing, for Graham, involves thorough analysis, understanding the business, assessing its value with the principal goals being the preservation of your capital, and earning an adequate return over the long term.
Okay, analysis, safety long term. What about speculating?
Speculating is primarily focused on anticipating price movements. It often involves shorter time horizons, less emphasis on the underlying business value, and, frankly, a higher degree of risk. It's more like betting on which way the price will go.
We found some great quotes illustrating this. Philip Carrot said investors look at value, speculators watch the ticker. Graham himself said analysis protects the investor, but not the speculator.
And John Bogle contrasted the long-term ownership of investing with the short-term trading of speculation. They all echo Graham's point.
Graham had that analogy too, didn't he, about Cinderella?
Yeah, the speculators like Cinderella at the ball. They think they can enjoy the party, the rising prices, and get out just before midnight when the bubble bursts.
But they often stay too long.
Exactly. They get caught up in the excitement and miss the exit. Buffett's test is also great here. If I buy a stock, I don't care if the market closes for years. That's an investor's mindset.
Because they care about the business, not just the daily price.
Precisely. Understanding if you're acting as an investor or a speculator is like step one for sustainable success in the market.
Okay, we've laid out Graham's big ideas pretty well, I think. Value, margin of safety, Mr. Market, thinking like an owner, the investor types, financials, investing versus speculating. Now, the big question. How relevant is all this today? It's an 80-year-old book in a very different world.
That's the million-dollar question, isn't it?
Yeah.
And there are definitely different perspectives. That Reddit discussion we looked at was interesting. Some people there felt the intelligent investor is maybe too dense, too much for a complete beginner.
Suggesting starting with something simpler, like Millionaire Teacher or Bogle's Little Book of Common Sense Investing.
Yeah, exactly. Easier entry points before tackling Graham's depth. There was also talk about some specific advice feeling outdated.
Like the rule about only buying stocks with a 10-year unbroken dividend record.
Right. I mean, that would rule out tons of successful growth companies today that reinvest everything back into the business instead of paying dividends. So, strict rules might need adapting.
But the underlying principle of valuing a company, that still matters, right? Even if the rules change.
Absolutely. That seems to be the consensus. The how might evolve, but the why, understanding value, remains critical. Although another point raised was that technology and algorithms might make finding those really obvious, deeply undervalued stocks much harder today.
The low-hanging fruit might be gone, the market's more efficient.
Potentially, yeah.
Yeah.
It feels like the easy bargains Graham might have found are rarer now. And beating the market consistently is incredibly hard, even for the pros, as some Reddit users pointed out.
There was also that critique about relying only on standard GAAP earnings, wasn't there?
Yes. The idea is that sometimes those reported earnings can be skewed by one-off items, non-cash charges, things that don't reflect the core ongoing profitability.
So a modern enterprising investor might need to look beyond the headline number, make adjustments.
Exactly. You might need to dig deeper to get a truer sense of the underlying earnings power. Blindly following every single Graham rule today might not work perfectly. It's about adapting the wisdom.
But even with those caveats, those adjustments for the modern world, it sounds like the core principles haven't lost their shine.
Not at all. Things like margin of safety, understanding market psychology. Mr. Market is definitely still alive, and kicking those seem timeless.
Buffett still recommends chapters 8 and 20, right? Mr. Market and margin of safety.
He does.
Yeah.
He considers them foundational. The basic wisdom of buy low, sell high based on value with a safety cushion. that endures.
And even critics acknowledge the importance of investor discipline, that emotional control Graham emphasized.
Hugely important. Maybe even more important in today's hyper-connected instant news world.
So, practically speaking, how does someone apply this today, if the formulas need tweaking and the easy bargains are harder to find?
I think the key is focusing on the mindset and the core concepts. Understand the difference between price and value. Always insist on a margin of safety, whatever that looks like for you. Learn to recognize and resist emotional decision-making driven by market swings.
So maybe for beginners, it's less about mastering complex valuation models immediately and more about grasping these fundamental pillars.
I think so. Get the foundations right first. And then, if you want to go deeper, there are tons of resources. Financial sites like Morningstar, Yahoo Finance, research tools like Value Line, Guru Focus.
And other great books that build on Graham, right? Like The Motley Fool Investment Guide, Peter Lynch's One Up on Wall Street, A Random Walk Down Wall Street.
Plenty of places to continue learning, definitely.
Okay, so let's try and wrap this up. What are the absolute must-remember takeaways from Graham's Intelligent Investor?
Number 1, focus on intrinsic value, not just market price. Understand the business.
Number 2, always demand a margin of safety, build in that buffer.
Number 3, recognize Mr. Market's emotional swings and use them to your advantage. Don't get swept away.
And number 4, know the crucial difference between investing for the long haul based on value and just speculating on price moves.
That sums it up pretty well. It's about analysis, discipline, and patience.
So here's a final thought to leave you with. In today's world, with information flying everywhere, 247 news cycles, and high-speed trading, how can the slow, patient, disciplined approach of value investing actually give you an edge? Or maybe, put another way, how do you best apply Graham's principles when finding those deep discounts feels like searching for a needle in a haystack? Something to think about as you navigate your own investing journey.